Welcome back to the channel. In today's video, I'm going to be reviewing BlackRock BST Science and Technology monthly ETF versus JEPI, the JP Morgan monthly ETF. These are two ETFs that I used to own, but I never actually did a review of them. So we're going to start that right now. So BST, the BlackRock Science and Technology Trust, year to date, it is up 9.29%. Is currently sitting at $31.17. On the 1 year chart, it's up 7%. And then on the 5 year, it is up 6.67%. But as you can see, it actually shot up as high as $58.79. That's on June 25th of 2021. So it's actually lost a significant amount of value since that time period. And I was actually really negative when I owned this stock as well. So if we go over to JP Morgan Equity Premium Income ETF, or easier to say JEPI, it's currently down 1.71% year to date with a price of $53.54. On the 1 year, it's up 2.72%. And then on the 5 year, it's up 6.89%. This stock also rose up quite a bit but this time in 2022, up to $63.19. So it is down from its all-time high. And next, we're going to look at Seeking Alpha. This is BlackRock's dividend summary. They have a current yield of 9.48%, an annual payout of $3. And it says they have a 5 year growth rate of 13.12%, but 0 years of dividend growth. So it's actually been a little over 2 years, coming up on 3 years since they've increased their dividend. So I would not really call them a dividend grower. Now, next, we're going to look at JEPI's dividend summary. They have a slightly higher yield at 9.68%, and they have a higher annual payout of $5.23. And it says they have dividend growth of 2 years, but from my experience, their dividend was actually going down in this previous year, 2023. So now we're going to go over to the fact sheet for BST. They're a closed-ended equity fund, and they spend 80% of their income in equity securities issued by U.S. and non-U.S. science and technology companies in any market. And then also, as part of their investment strategy, they employ covered call options on a portion of their common stock. So we scroll down over here. They have the number of holdings, 108. Their top holdings are Microsoft at 8.65%, Apple at 8.3%, Nvidia at 5.95%, ASML Holding at 2.73%, Tesla at 2.46%, Cadence Design Systems at 2.37%, and then you have MasterCard, Broadcom, Project Debussy, and then Amazon to round out the top 10. And that has a total value of the portfolio at 38.93%. But these are all solid companies and their top holdings. Of course, a few of them are unknown, like ASML, Cadence, and Project Debussy. But overall, it's a pretty good top 10. Then if we look at their distribution history, you can see they just pay a consistent 25 cents every single month. And that is one thing I liked about BST is they had a consistent, just flat rate. So you could always count on the dividend being the same every single month. Whereas with JEPI, the dividend did go up and down over time. Now, if we look at their sectors, of course, it's pretty much majority tech, software and services at 35.1%. And then they don't show what's at 25%, but they have tech and hardware and equipment at 11.4. Then they have media and entertainment, financial services, consumer services, autos and components, and then other, and then transportation. They also show their geographic breakdown, which is 80.8% US. And then they have Netherlands, China, France, Japan, UK, Canada, South Korea, Australia, and then the Cayman Islands. And then if we look at their annual expenses, they have a gross expense ratio of 1.11%, a management fee of 1%. So that is insanely high expense ratio for this ETF. So next we have the fact sheet for JEPI. And so they generate income through a combination of selling options and investing in US large cap stocks. And they seek to deliver that monthly income through the option premiums and stock dividends. And they constructed a diversified low volatility equity portfolio through proprietary research process designed to identify over and undervalued stocks with attractive risk return characteristics. And they seek to deliver a significant portion of the returns associated with the S&P 500 index, but with less volatility, in addition to monthly income. So you can see here their expense ratio is 0.35%, which is still a really high expense ratio, although it's a third of what BST's expense ratio was. So now let's scroll down to their top 10 holdings. They have Amazon, Adobe, Microsoft, Comcast, MasterCard, Intuit, AbbVie, Accenture, PepsiCo, and Visa. And these are all pretty low ratings in the 1%. And these are all great stocks. Some overlap with BST. And then you can see their sectors. They have communication services, consumer discretionary, staples, energy. In the over 10% range, they have financials, healthcare, industrials, information technology, and then other. And they also have materials, real estate, and utilities. So it's a pretty well balanced sector percentage. So next, you can just see portfolio analysis of JEPI, and I'm looking for their total number of holdings, 134. So just a little bit more than BST on the total holdings. So now let's look at the back test for BST and JEPI. So I put in $1 million, reinvest the dividends, display their income. So let's check this out. With an initial balance of $1 million, you finished at 744,000 for BST and 1.2 million for JEPI. And this is just over the course of a few years. So from 2021 to 2023. So not that much time because these are relatively new funds. However, you can see in the best year category, BST's best year was 18.63%. JEPI's beat that out at 21.51%. Then if we look at the worst year, BST had the worst year at negative 38.29%, and JEPI had the worst year at negative 3.53%. And then if we just look at the chart, as you can see, just BST just took a nosedive after they ran up before. And JEPI actually came up in value and then stayed pretty consistent while rising slowly. So on the overall growth, I would say JEPI wins out on this just because they remained positive. So now I'm going to go over to portfolio income. So in 2021, BST had more income at $82,460. JEPI had $77,077. So not that far off. And then as you can see in 2022, BST's dividend income was actually lower at 63,000, a little over 63K. And JEPI ended up the year with over double BST at 128.5 thousand. And the reason BST's dividend income was a lot lower in 2022 was not because of any dividend cuts. It's just because they gave a larger bonus in 2021. So they usually give a bonus at the end of the year, which they did in 2021. They didn't do that in 2022, and I doubt they will in 2023. But as you can see, BST's income so far for 2023 is $51,331. And JEPI's dividend income so far in 2023 is 67,852. And this year is almost over. So I doubt JEPI gets up to the six-figure range because there's only about 2 more months of payments left in the year. So, that being said, my opinion on these two stocks, and the reason I actually got rid of both of them, so I enjoyed BST giving me consistent, like I said, the flat rate of dividends, but I got rid of BST because they weren't growing their dividend. I believe that they could have at least increased their dividend by 1 penny in 2025 or in 2022, and then increase it by at least a penny in 2023 until interest rates lower, the market and the economy gets better. But they couldn't even do that. So if they would have done that, I would have held on to BST. And then the reason I got rid of JEPI is just based on my last point. They had huge dividend income in 2022, and then now their dividend income is going to drop in 2023. And while I do believe it'll be more than 2021, if you're relying on dividends, like in the future when you're retired, you really don't want to have such huge swings because that's gonna like really affect you, especially when it comes to inflation. I would prefer to have, those ETFs like SCHD, which has the over 13% dividend growth rate, which over time will beat inflation. Then, of course, if you've seen my other videos with my overall stock portfolio, has a dividend growth rate of around 8%, which I believe over time will outperform inflation. So when I look at my stock portfolio as a whole, I want dividend growing companies that have a average dividend growth rate for my overall portfolio over 7%. And I currently have that. So maybe in the future, when we have a lot more data, maybe 10 years, 20 years, I might come back to these stocks. But for now, I'm just going to stick with my current strategy of 100% dividend growth stocks and ETFs.